When you want to book some profit from your portfolio, what do you generally do? If you want some money and you want to cash it out, we generally sell shares which are profitable. We don't sell shares which are in loss. That's a very, very big bias. And there are hundreds of such biases which we do on a day-to-day basis in our investing journey. And with the practical examples, I'll be unveiling top 5 such biases which we have as an investor, the traps which we go through, which can let us suffer big, big losses. And if you are able to overcome these biases by understanding them, you can be in the top 1% investor. So, hello, my name is Vivek Mashrani, and today we are going to learn top 5 such biases and traps which will help you in your investing journey to navigate much faster. So, if all of you are ready for this, just type ready in the comment box and let's begin. What are these biases? How we get trapped into it? And if we avoid these biases, how we can get into the top 1% of the game. And by the way, whatever biases I'll be sharing and all the entire PPT, I'll be giving you this as a gift, so I'll be giving you the entire PPT as a gift so that you can revise and go through it again later as many number of times as you want. So let's begin. Let's go for this session. All right, so let's begin with the agenda. As I said, we are going to cover multiple topics. We are going to cover how, investors get into the biases. We are going to learn about how, as an investor, we can take benefit of these biases if we implement in the right way. And what are the different case studies which we might have encountered in our life to connect with these biases. So it will be very, very practical masterclass. Please take a lot of notes so that you understand. Let's come into the first biases, okay? And let me share the PPT so that all of you are able to see. Hope you are able to see my PPT. Yeah, so let's come to the first bias, and before that, just a quick disclaimer. All the stocks are for illustrations as usual. These are not recommendatory. So even if I'm giving you any example, just say, use it for connecting the dot with a particular concept and not like just go and buy it or go and sell it. Okay, so let's first go about anchoring bias. Now, what is anchoring bias and how does it affect us? So if you think about anchoring bias, just like the name suggests, it is like an anchor. Okay, and like how when we want to stop a ship, generally the anchor also is kind of pulling you back and it will stop you in the shore. Same way, investors also behave. Now, what is this anchoring bias? Where it is, used? You might have seen this very, very frequently. How many of you have, by the way, gone for shopping to any of the shopping malls? If you've gone for shopping, just type me in the comment box so that I know that some of you have gone for regular shopping. Okay, you go out and you shop something. You might have seen the tags. Okay, you might have seen the tags, and what does the tag suggest? Okay, so it's like this. So the first car, say for example, it has a tag of $30K or whatever it could be. You are buying clothes, you are buying jeans, and it has a price tag of say 2000 rupees. Okay, now same thing, if you are getting sold at say 4000 rupees and then there is a label that 50% off, you feel that hey, this is much, much cheaper, I'm getting 50% extra discount, but actually you are getting the same thing for the same price. Okay, so this is a perfect example of something called as anchoring bias, where something is showed to you but then you are anchoring it with something else. And same thing pretty much happens in the market. Okay, so what happens in the market, say for example, you have a stock which is say in 2011 you started researching that stock, and the stock price was say 1000 rupees, and you researched that company, you went through it, but somehow you did not buy it for whatever reason, and the earnings that time was 100 rupees. Okay, and essentially the multiple or the valuation you are paying for it is 10 times P, right? So price, how many times you are paying for earnings? You are paying 10 times of the price. Now what has happened, fast forward 2013, and you come across the same stock again. Now what happens? We feel that The stock price has now gone to how many rupees? It has gone to 3000 rupees. And due to what it has gone to 3000 rupees? Because the earnings, if I just activate my pointers, you can see the earnings here was 100 rupees and now that has become 200 rupees. Okay, so the company has grown and it has grown, you know, from 100 to 200. Okay, let me again get back to the same pointer. And the PE has gone from 10 to 15. Now tell me how many people who have seen 1000 rupees before 2 years will be able to buy the same stock at a much higher price of 3000 rupees. This is where our mind starts thinking that hey, this same company I was getting at 1000 rupees. Now fast forward 2 years, I am paying expensive looking price for this particular company. Okay, so that is where the anchoring bias comes into the play. That okay, same thing, I'm buying for three times the value. But is it true? Are we buying the same company? We are buying the same name of the company, but it is now in a different trajectory altogether. So it has doubled its earning in less than 3 years. In 2 years, it has doubled the earnings. And even PE has gone from 10 to 15, but it might happen that because this company is growing much faster, it might be much powerful decision for you to buy that versus other company. Are you all with me on this? Are you all able to understand why this is a better decision even at a price of 300? But most investors will not be able to do that. They will ignore this company and they will move forward. Okay, and what happens next is just, we all know that, right? What happens ultimately, this company will go from 3000 rupees to 5000 to 10,000 and so on and so forth. So that is the first bias a lot of us as an investor go about. The second bias is again very powerful, which is called confirmation bias. Now what is confirmation bias? Confirmation bias is like we filter the information which we want to like it. Okay, so if we really like that company and we already almost decided that I want to buy that company, or you are already invested into that company, among all the information that comes in, you will try to buy only those information which is congruent to your own thesis or analysis. So you will not hear to contra ideas. Okay, so you will have selective information filtered. You will be having a biased shortlist of your ideas, and you will ignore contradictory facts. Somebody will say, hey, this is a big risk into this company, you should avoid it, but then your mind will not allow to avoid it. Okay, and that is the reason many people just when they have bought that stock, they don't want to listen to anybody. They keep buying again and again the same stock despite lot of contradictory facts that might be coming in the picture. And that is the reason you actually need a system in place. Okay, you need a system which can help you, and I've covered in multiple of my session. Even if you have attended my introductory webinar, I've covered that. And if you are not attended, you can obviously attend this. I will also share the link in the description below. But you can go to technofunda.co/webinar and you can go through it. By the way, after this, I'll be sharing this PPT also. So in the next point, I'll be sharing the PPT, which you can download, and you can actually have a record of all these biases. So first bias, just to recap, anchoring bias, where we anchor the previous price, even though the fundamentals have changed, even though the company is totally in a different trajectory, we compare that with the historical price to take our decision. Second, confirmation bias, we only filter that information which we want to actually hear. Okay, and we ignore everything else. Even if it is contradictory, we don't pay attention to it, and that many times it takes us in a big losses. Now third pretty much is called something called as gambler's fallacy. Okay, now gambler's fallacy is very simple. Okay, so if say you get a dice and you throw that dice and say you got two as a number two times. Okay, and then you get one more time two, one more time two, and then you start thinking that okay, ab to bahut ho gaya, teen char baar aa gaya, now two will not come. And you kind of think about mean reversion, which as a thumb rule it is fine, but it is not very conducive to your investing journey, because uh, you know past can continue. The momentum of a company can continue for a very, very long time. But here you are believing that, hey, ab to bahut ho gaya, now, it is, the story is over. But then the story keeps unfolding again and again and again after this long, long time. Okay. So that is where, this bias is very, very powerful. Now if I want to talk about the examples, right, so let's take examples of couple of things which we discussed so far. So if you take an example of confirmation bias, say for example, when Reliance IPO came, Reliance Power, in 2008, many investors were very bullish, and even though a lot of contradictory data came in around high valuation and there is no business yet started, everybody jumped into it. Now, if we go about the bias of, gambler's fallacy, you have a lot of these examples like, Varun Beverages, where, say for example, the quarter on quarter growth came in and it kept on continuing. But if you are following this bias, then what will happen? You will realize that, that growth will continue again and again. So sometimes, the company is growing and we feel, now 2-3 quarters it has grown, now it will not grow. But then it continues to grow, it continues to move forward. And if you see, companies like Varun Beverages, I'll just show you the graph, and let's also check about the earnings growth. Just give me a second, I'll just share the screen so that all of you can relate with it. So something which is performing already can continue to perform for a very, very long time, right? So let me share the screen and you will be able to see the Varun Beverages graph, right? So it continued to perform for a very, very long period of time. Same way, a lot of these, railway stocks and defense stocks, like say Titagar Vegan, okay, you might get into the same trap if you think that, okay, it has moved so far, right? So if it has gone from say 46 rupees and it has already become say 5 bagger or 3 bagger over here, somebody would think that, okay, now it has already become 3x and now the, earnings have started coming in, but it is, story is over. And from 100 also, you might see it has gone like crazy, more than 1000 rupees also. So the point is, always look at facts, don't get biased. And if you see Varun Beverages and a lot of these companies, the growth kept on coming again and again. Okay, so if you see the quarter on quarter growth, the number started, from 2021, it started the momentum, and that momentum really, really went big. And that is where, one, you should avoid anchoring bias, and second, you might have an anchoring bias towards multiple also, that, okay, my PE ratio looks high, and then whether this growth will continue, and that is where we prematurely exit some of these businesses. So are you all clear so far how to think about this? And yeah, by the way, I was going to share the presentation with you. Let me share the link of this presentation. So if you go to technofunda.co/traps, okay, you will be able to download this entire PPT which I'm sharing with you, and you can go through it and revise all the concepts which I'm sharing with all of you. Okay, so please make sure you get it. And by the way, if you are liking the video so far, and if you learned something really new, just hit a thumbs up so that I know that you are liking it and you are getting all the concepts so far. Okay, now we will move to a very, very powerful next concept, which is called self-attribution. Okay, so self-attribution is like apunich bhagwan hai, I am hero, mujhe sab pata hai, right? And that is the least thing you should be doing in investing. Okay, in investing, we need to keep our ego away. We don't need to think I know everything. Instead, we should be a learner in the market. We should be always having a mindset of learning something new from the market all the time. But that is what not all investors do. They attribute the bull market success to their excellence. They say, hey, I know everything, mere ko to itna return mila, now whatever I pick will run. Okay, and because of this, what happens is they get into the overconfidence and they forget about risk management, they forget about allocation. Okay, so they start building bigger position. Even if the exit triggers, they don't exit, and that is again a worst thing you should be doing. Like I keep saying that in investing, Your rule should be you protect your risk first. So if you focus on risk first, the returns will automatically get taken care of. Okay, if you ignore risk, then it will eat you away. Okay, so if you want to compound your money effectively, if you focus on risk management first, automatically the compounding will happen. But many people don't get it. They feel, if I over allocate, I put huge money in one go, if I avoid exits, I'll make more money. That is not the case. In fact, one small mistake where you have not exited, and that consumes your entire portfolio also, that is also possible, right? So coming back to our slides, self-attribution generally is attributed to the bull market. So if something really good happens good, they don't attribute it to the market. They say, hey, I did it. I found this stock. I was right. Okay. And if something bad happens, that stock starts falling, they say, hey, this sector was like this. I generally don't invest in this, but I did it, and all sort of those things. Okay. By the way, if you have not watched some of these videos on different concepts which I'm talking about, there are a lot of videos which you can go through it. In fact, the latest one, if you want to see, in the third Modi 3.0, the third 5-year term of Mr. Modi and BJP, what all sectors you should look for and how to analyze the sector. I've just covered a deep dive into it. And if you also want to understand how to pick up like strong stocks, I've covered a very, very powerful video. So if you can search with Vivek Mashrani top performing stocks, you will be able to get the entire video and you can go through it. Okay, so make sure you go through a lot of these powerful videos which are already there in the channel. Now let's come to the loss aversion example. Like, what is the perfect example to know this? So think about you know 2006 and 7. You say you invested into infrastructure sector, real estate sector, and you were very happy that, oh, you made a lot of returns. A lot of these stocks like Unitech, DLF, that time became multi-bagger. And then 2008, housing crisis came in and real estate bubble was there. It got busted. Now, because of this self-serving bias or this, bias around self-attribution, you will say, hey, I did the old right thing. You will not exit, despite market telling you otherwise. You will ignore the facts. Again, combining it with the earlier concept of confirmation bias, you will only filter that information which you feel is aligning with your decision. You will ignore all the fact that, hey, there is always a recession happening, there was a housing bubble, and India also has got affected. You will all ignore that decisions, and you will not exit. You will not book profits even though you are sitting on a big profit. And that is where, one can lose big. Okay, so this is another very, very prominent bias called self attribution bias, where you are trying to attribute things which has worked in your favor and you are ignoring others. So this will create bias in terms of ignoring your exits. Now, last but not the least, this is like very, very powerful. I was telling to you initially, right? Imagine you are in need of money and you have a say portfolio of 1 crore rupees and you want 10 lakh rupees from it. Tell me in the comment box, what will you do? Will you sell 10 lakh rupees worth of stock which is in loss, or you will sell 10 lakh rupees worth of stock which is in profit? What will you do? Just type in the comment box, one which is in loss or one which is in profit. Quickly type, let me see who all are responding, and I'll quickly check your names, and also if you are watching the recording, I'll try to respond your comments. So let me know, what will you do? Generally, what I've seen is most investors will sell their profitable positions, right? Unless you are part of TechnoFunda community and you have really understood how to ride winners and what is the winners, and you've gone through the entire hackathon. Generally, what investors do is they see that, okay, hey, this is like the most profitable position. Let me trim some of the profit and let me book some of the profit. They will never book loss. Why? Because loss taking is difficult. Psychologically, it's not easy. Okay, it takes a lot of guts to actually book losses. Okay, so they always want to avoid losses. Okay, if it starts going down, they will say, hey, hopefully it will come up, or they will, worst case, what they will do, they will average down. Okay, they will buy more as it goes down. Why? Because they want to feel good about their loss. So they will say, hey, I will bring my average price down so my loss will decrease. Actually, they are not decreasing the loss. The loss is same. If they buy new position and it goes down, the loss will actually become bigger. Okay, but they always think like a gambler, that okay, loss is okay and something somewhere it will improve. Okay, so what are the side effects of this loss aversion? So one, you will do revenge trading. I've seen a lot of people who do particularly trading, intraday trading or F&O. They have lost some money. Like there is this, kahavat that hara hua juari double khelta hai. Like in Mahabharat also you have seen like entire Kauravas, they had lost the Pandavas, right? They lost entire fortune because of gambling. Because if you are in loss, you want to double down. You want to do more of it. So that is where revenge trading a lot of people do, and even if they are into loss, they go into bigger loss and ultimately get out. Investors, particularly what I've seen, they will keep averaging down. Okay, what I mean by averaging down, let me show it to you. So let me give you an example of say what company you want to share, which is the perfect example of averaging down. I think Yes Bank is very prominent example for a lot of investors. Okay, so let me show it to you, or even DLF for that matter. Okay, so what investors generally do, let me share the screen. And say for example they have bought here. Okay, and then it starts falling, and suppose they are at this point and they are in loss. They will not book the loss. They will say, hey, I'll buy more. So they'll buy more here. Then they'll buy more again. 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 And they're almost 90% of the portfolio will be gone into this one stock. Now, a lot of people, then they come and thump their chest. Hey, I told you to buy here. I bought at 10 rupees. Now it became 20 rupees. I doubled my shares. But imagine when you have gone down from even 100 rupees to 10 rupees. Okay. To recover that 100 rupees, you need to go 10x. You need to multiply it by 10x. Only then you are recovering your cost. You are not even making profit. So please remember that when you are going down, the going of 10% requires a up move of 10%. But as you go more than that, like if you go say 20%, you need 25% to recover that. If you go down 50%, you need 2x to recover that. But people ignore that math. And that is where, they repent later, but they do this mistake. Okay. So this is what is a perfect example. Let me share the screen again so that all of you are able to see. Okay, let me share. Hope now you are able to see the screen. Okay, so Yes Bank is a perfect example. So you want to avoid the pain. Okay, and from 400 rupees it went all the way down to 5 rupees. But a lot of investors, keep adding that position. So that is about the entire 5 biases which I wanted to share with you, and hopefully you were able to note down all the points. So revenge trading, averaging down, ignoring negative facts about the company, that is also very prominently seen inside this bias. So that's it from my end, guys. Hope you enjoyed the session. Keep compounding, keep learning, keep growing. And if you have not picked up 2 of these books, please go for it. We have 2 books which I've written. First is You Can Compound, which is on investing, and second is Action, which is on personal finance, where you can, in a simplified way, learn more about personal finance. Right. So if you have any questions, feel free before we break for this session. And once again, if you are not downloaded the PPT, I would share the link with all of you so that you can download it. So let me give the link with all of you. So here is the link. Go to technofunda.co/traps to download this entire PowerPoint presentation. Okay, so just to recap what we did so far. First, we learned about anchoring bias. So if price changes from where you have seen this, you ignore the change in fundamental, the way the company has grown, and you actually miss a company which is actually becoming better and better just because you have anchored yourself with a certain price. And many times, people are not able to average up also their winners because of this bias. The second bias is confirmation bias. So we learned about only filtering the information which you like to get because of your past decision or your bias inside that company, and you ignore negative facts and you only focus on the right facts. Because of this, people are not able to exit even if the contradictory facts are coming, and people take over allocation into some of the positions because they are heavily biased towards it, and they ignore all the noise around it. The gambler's fallacy is like you say that, hey, something which has happened in the past will not happen in the future, and because of this, something which is growing like crazy and there is a averaging up opportunity and companies into very nice good compounding journey, we either book profit too early or not allocate more, or worst case we don't even take position into it, right? So this is again a very very big bias which all of you should avoid. The fourth one which we discussed was self attribution, which is like giving all the credit to ourselves and ignoring the role of luck, role of market movements, and because of which we are not exiting at the right stage, we are over allocating, and sometimes that turns into a big loss also. And finally, loss aversion. So loss aversion is where we are very not very happy to take a loss, and we try to avoid loss as much as possible, but we try to book profit early, because of which we are not able to ride winners, we average down, and most importantly, we sometimes don't even exit bad stocks, and it remains in our portfolio for lifetime and keeps draining our returns down. So these were the top 5 biases. Hope you enjoyed this video, and hope you will not make these mistakes, you will not fall into these investing traps. And my promise is, if you avoid these investing traps, you will be into 1% club of investors where you are cruising and making much better returns than other investors. So that's it from my end. Thank you so much again for joining this session. If you're not connected with me on this channel, just subscribe to this channel so that we can learn together, grow together in this journey. And once again, keep compounding. Bye bye.